Good afternoon, everybody. I'm David Huff, CPA with DW Huff Consulting, here with the July 21st, 2023 edition of News from the Front Lines of Business. Here we like to help everybody build, grow, and enjoy their wealth. So here we are. Looks like we made it through another week here. Decent amount of stuff going on, I would say. Mid-year's upon us, so there's a lot of tax planning considerations to be discussed, and one of which came up in discussion this week is how to update your W-4 form. So if you are looking at last year's tax return like we suggested you do, compare it to your pay stubs or whatever other records you have that would show how your income is starting to shape up at this point in the year. And if those numbers look like last year was substantially lower than you are projecting for 2023, you may need to make some changes. So you can update your withholding at work would be one way, make some estimated payments would be another. But this W-4 form we find is a bit confusing. So I know it might be a little bit hard to read, but this is what the new form looks like. So if you want to change something on your withholding, you go through the process, you check the box there at the top for whether you're single, married, or filing separately, a head of household. So whatever status you want to use, start there. And then you go to this other section where you're actually going to calculate how much additional withholding might be needed. So that's based on whatever filing status you choose. There's a base amount of withholding that's going to happen no matter what. But then they have you go through these worksheets. So depending on which of these scenarios on the second page of the form fit you, check a box, you go to another table, it's going to calculate a dollar amount, and you divide that by the number of pay periods and bring it to the front page of the form. So it's a little bit of work, and I don't feel like it's overly complicated. However, most normal people who aren't dealing with this kind of stuff every day might get a little twisted in knots because the tax language isn't always English language, right? So what I would suggest to you is once you got an idea of how things are going to shake out. So if you looked at last year's tax return, let's say, and you owed $2,000, I would just go and if things looking the same this year, then let's just say $2,000 is the number we want to increase our withholding by, so we don't owe anything. So if it's up or down, you might want to adjust it one way or the other. But all you got to do on step 4 here, line C, that's the extra withholding amount per pay period, just write in a number there. So if let's say last year's summary tax data showed me that everything shook out, I owed $2,000. This year's the same, withholding's the same. I didn't change anything yet, and I want to get an additional $2,000 withheld. Just divide it. Just go to this line. So without going through all the hassle of the extra worksheet and then trying to back into a number, just figure out a way. Figure how many pay periods you have left. So if you're getting paid once a month, and here we are in July, so you assuming you have 6 more pay periods left, take the $2,000, divide it by 6, and just put that number here. So however it shakes out, how much ever extra you want to have withheld to make the tax bill go down to 0 next year is what you put here. So if income is substantially higher, then it gets a little more tricky. You still might need to go back to the tax hit. So there's a way to figure out what the tax hit will be. Going back to those tables and everything. So or you can just send me an email. And most times we can get to a number pretty quickly. But at a minimum, I think you want to make sure you have more tax. Especially if you owed, you want to make sure you have more paid in than you had last year. So take some number, drop it in here, and be done with it. So talk to me about it if you have more questions. But the workbook is good, and it's not impossible, but just drop in some number in 4C to get an amount in there by the end of the year that makes sense and makes you feel good would be a good starting point. So if you don't have any, if you don't want to waste the time to really go through a formal tax planning engagement and calculation, just do that. All right, so you may have noticed that we've changed some of our graphics for this BGE concept that we have here. So that's my build, grow, enjoy financial system. And I guess to summarize it briefly, what we've kind of done over the years is we kind of noticed financial planning, on a comprehensive financial planning, could be a little bit overwhelming because you have not only the investments, was what I think most people only think of, but there's definitely a tax planning component, a life insurance component, some other parts that have to do with the debt that you might be carrying. So there's a lot that goes into it. But depending on where you are in life, how old you are, basically, certain systems need to be looked at immediately and have a very intense focus, where others can be kind of kicked down the line a little bit. So build, grow, enjoy, right? So I this is one of my notes here from some documentation I'm kind of working up here in some slides. But so if you're looking at like a marine invasion attempt here, a marine landing, building is like your base phase there. You're on the beach, you're advancing. So to equate that to where you are in life, that might be where you're just starting out. You've either been at a job for a while, you're just starting to work and earn money and have things that you need to do. So that's what a build is. Really want to try to build up some assets that we can later in the grow phase invest. So so the grow phase is like when you've if you're equating it to a landing operation, you've landed, you got some money in the bank, and now you need to kind of start deciding what to do with it. So whether you're going to be using retirement plans that are employer-based at work, or you're going to do something else, or possibly even add in some real estate. All these things kind of are ways to take what you've already earned, now start growing it into something that's hopefully going to make some money for you later on in retirement. So, and then the enjoy part of it is how to pull money out of these investments. So definitely there's some strategy involved when you're trying to pull money out of your retirement accounts. We definitely want there's some tax planning that can be done there to make sure that those assets last as long as possible. Pulling money out of real estate property. Sometimes if you've been doing a bunch of property, you might want to start downsizing. So there's a way to do like-kind exchanges and get out of some of your properties in a tax-favored way that we spend some time with. So so depending on where you are, you don't need to we don't want to worry about necessarily a withdrawal strategy when you're just getting started. We have other bigger things to focus on at that early phase. So depending on where you are in life, how old you are, and how much wealth you've accumulated, that determines which things we're going to spend our time on. So build, grow, enjoy. You'll be seeing a lot more of that as we get going here. And anyway, that's what we've developed the last 26 or so years of being in practice. All right. So another discussion we had on investment, I guess it's kind of sort of related to our build, grow, enjoy. Investment management. So where should you focus your performance? So client came in looking at his portfolio, and things are up. This is a pretty good week, so things are up, and he's feeling good about things. And I hate to, I guess, be a wet blanket here, but I went back and said, okay, how is the income on your investment? So the value of the portfolio could be up and down depending on just market trends and stock market prices, and sometimes the overall market goes up and your stocks just get brought up. But we want to look at what's important, right? And what's important to me is how much money you can pull out of a portfolio when you get to the enjoy phase of your journey. So here we look at Coca-Cola. So that's a long-time company that's been paying dividends for a while, mature, stable, predictable. So I took a look at the 30-year returns here, and how that would look if you had $1,000 in it, and you just let it go for 30 years, and you took your dividends and you reinvested it. So regardless of what's going on in the market, here we see how that would have played out. So that 30-year time horizon would have grown your $1,000 initial investment to $11,943, or 8.4%, 7% combined aggregate growth rate. And the second portion of the chart is the income. So early on, because we had a few number of shares, the income was kind of low, and it started out, looks like less than $50 a year. It probably looks like about 20-ish or so a year. But as we go all the way to the end here, it's a little bit less than $350 a year of dividends. So I would say that's pretty good. Let's think of that for a minute. We put $1,000 into this portfolio, we let the market do its thing, and now we can stop reinvesting in dividends and receive $350 a year of qualified dividend income. And we just, we see this chart here, it's going straight up. So obviously Coca-Cola is growing steadily and increasing what they pay out. So that's what this second slide shows you. It says, well, here's how it looks if we don't reinvest the dividend. So if we don't reinvest anything, we still offer the same low amount there, less than 20 bucks. And if we don't reinvest it, we just pull the money out every single year and keep going, it's a little bit less than 175. So I know that's hard to read, but that's, just think about that for a second. So if you didn't reinvest it and didn't grow the actual number of shares you had, the dividend still went up to just under 175 a year without doing any extra work. So, so going forward, I think that the profit is going to increase with a company like Coca-Cola, and you would expect that your dividends are going to, hopefully keep up with inflation, but they're going to grow. So that's where I like to focus on when we're looking at our investment returns. I'm not real worried about what the market thinks about my price. I'm looking at the company and trying to make sure that their dividend that they're paying out is going to be sustainable for a while. But here's just another example of a blue chip, company here that just keeps on chugging along, making money. And so basically, it kind of, if you have the time to do something like this, it makes it a little bit easier for you to plan for your retirement income. And now we don't have to worry about getting into more complicated things like annuities and variable annuities and all these other things. Here, we have something that we could reasonably expect to grow and keep up with without having to take some of those more complicated steps. Buy it, reinvest it, spend it. So think of that. So the important thing is how much money you can pull out of your portfolio, not necessarily the value of the portfolio. So with that, here we are at the end of the week. I'll share with you one of my favorite sayings here from Jocko Willink: discipline equals freedom. So, I guess it's somewhat counterintuitive, because when you think about it, like in Jocko's case here, he always shows how he gets up every day at 4:30 to start his workout, and it's hard, right? So that discipline it seems like it's not freedom. If you're making yourself wake up at 4:30 a.m. every day to work out, that doesn't sound like freedom at first glance. However, when you do that, your rest of your day is free to do whatever you want. All right, so you got it done, you got your work done, you're over it. And I guess another way that the freedom comes into play is that now you're in a little bit better shape, so your quality of life's better, you may live longer. So by taking a step to make yourself do those little things every day and be consistent with it, you could have a better life, longer life, feel better. Everything's better when you have some freedom. So and that's the same concept I think applies with the financial stuff too. Forcing yourself to save little bits of money now every single week and putting it into a portfolio and letting it go. Might seem hard now because you're taking that $25 or so that we recommend you start with. That's something else you might want to spend that money on now. So it might not seem like it's freedom, but when you let it grow, look back at the Coca-Cola example, or any other examples we use, right? So when you just do that thing consistently and let it grow, you're going to have more to work with down the line. And and I think that's a much preferable approach to trying to scramble at the end of your life to figure out how to get money into like a retirement account or income generating asset. So with that, everybody have a great week. And remember, we're here to help you build, grow, and enjoy your wealth. Goodbye.